Welcome to Money Finance Wealth. Today we're diving into one of the most critical aspects of financial planning: asset allocation. Whether you're saving for retirement, building generational wealth, or achieving financial independence, asset allocation is the foundation of a successful investment strategy. What is asset allocation? Simply put, asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, real estate, and cash, to balance risk and reward based on your goals, time horizon, and risk tolerance. Why is it important? Because the mix of assets in your portfolio is the most significant factor determining your long-term returns and the level of risk you take on. Studies show that asset allocation accounts for over 90% of a portfolio's performance. As we explore this topic, remember that building the right allocation requires thoughtful planning, ongoing monitoring, and often the guidance of a trusted advisor. Professionals like Faneuil Wealth Management specialize in creating tailored strategies that align with your unique goals. Before you can create an effective asset allocation strategy, you need to understand the building blocks of a portfolio, the asset classes. Each one plays a unique role in your financial plan. 1. Stocks represent ownership in a company, offer the potential for high returns but come with higher risk. Best for long-term growth and outperforming inflation. 2. Bonds, fixed income securities issued by governments or corporations, provide stability and regular income, reducing overall portfolio volatility. 3. Real estate includes physical properties or investments like REITs, offers diversification, steady cash flow, and potential appreciation. 4. Cash and cash equivalents includes savings accounts, money market funds, and treasury bills. Provides liquidity and stability but limited growth potential. 5. Alternative investments includes commodities, private equity, hedge funds, and cryptocurrencies. Higher risk but may offer uncorrelated returns, enhancing diversification. Each asset class behaves differently under various market conditions. By combining them thoughtfully, you create a portfolio designed to weather market fluctuations while working toward your financial objectives. Asset allocation isn't a one-size-fits-all strategy. Your mix of assets depends largely on your risk tolerance, which reflects how much volatility you're comfortable with and how much loss you can bear without abandoning your plan. Here are 3 primary risk profiles and how they influence asset allocation. 1. Conservative investors prioritize capital preservation over high returns. Typical allocation: 70% bonds, 20% stocks, 10% cash. Ideal for those close to retirement or with short-term goals. 2. Moderate investors seek a balance between growth and stability. Typical allocation: 50% stocks, 40% bonds, 10% cash. Suited for mid-career individuals or those with medium-term goals. 3. Aggressive investors prioritize high returns and are willing to accept significant volatility. Typical allocation: 80% stocks, 15% bonds, 5% cash. Ideal for younger investors with long-term horizons. How to assess your risk tolerance. Reflect on your emotional reaction to past market downturns. Consider your time horizon. Longer horizons allow for more aggressive allocations. Use online risk assessment tools or work with a financial advisor. Understanding your risk tolerance is the foundation for a portfolio that grows with confidence and peace of mind. Your time horizon, how long you plan to invest before needing access to your funds, is a critical factor in shaping your asset allocation. Let's break it down. 1. Short-term goals, 0 to 3 years. If you need your money soon, prioritize stability over growth. Typical allocation: 70% cash, 20% bonds, 10% stocks. Example: saving for a down payment on a house or a vacation. 2. Medium-term goals, 3 to 10 years. Strike a balance between growth and preservation. Typical allocation: 50% stocks, 40% bonds, 10% cash. Example: saving for a child's education or a large purchase. 3. Long-term goals, 10+ years. Focus on growth to maximize returns over time. Typical allocation: 80% stocks, 15% bonds, 5% cash. Example: retirement or creating generational wealth. As your time horizon changes, so should your asset allocation. A portfolio that starts aggressively when you're young may shift toward more conservative investments as you approach retirement. Professionals like Faneuil Wealth Management can help you align your asset allocation with your evolving time horizon to stay on track toward your goals. Diversification is the cornerstone of effective asset allocation. By spreading your investments across different asset classes, industries, and geographies, you reduce the impact of any single market downturn on your portfolio. Here's how diversification works. Across asset classes, include a mix of stocks, bonds, real estate, and cash to balance growth and stability. Within asset classes, for stocks, diversify across sectors like technology, healthcare, and energy. For bonds, include both government and corporate bonds with varying maturities. Across geographies, invest in domestic and international markets to capitalize on global growth opportunities. Adding alternative investments. Consider commodities, private equity, or cryptocurrencies for added diversification. Why diversification matters. It reduces portfolio volatility, ensures smoother performance during market turbulence, and provides exposure to multiple growth opportunities. Achieving true diversification requires careful planning and periodic rebalancing, which ensures your portfolio stays aligned with your goals. Over time, market fluctuations can cause your portfolio's allocation to drift away from your original plan. Rebalancing is the process of realigning your portfolio to maintain your desired mix of assets. Here's why and how to rebalance. Why rebalance? To control risk. A portfolio that becomes too stock-heavy may be riskier than you're comfortable with. To lock in gains. Rebalancing allows you to sell high-performing assets and reinvest in undervalued ones. How often should you rebalance? Annually or semi-annually is sufficient for most investors. Alternatively, rebalance when your allocation deviates by a set percentage, say 5 to 10%. Rebalancing methods. Sell overweight assets. Sell assets that exceed their target allocation and reinvest in underperforming areas. Use new contributions. Redirect new investments to underweight asset classes to avoid selling existing holdings. Example of rebalancing. If your target allocation is 60% stocks and 40% bonds, but stocks grow to 70%, rebalance by selling stocks or buying bonds to restore balance. Regular rebalancing keeps your portfolio optimized for long-term growth and helps you maintain the right level of risk. Even seasoned investors can make mistakes when it comes to asset allocation. Here are some common pitfalls and how to avoid them. 1. Ignoring risk tolerance. Over-investing in high-risk assets can lead to panic during market downturns. 2. Over-concentration. Putting too much into one stock, sector, or market increases vulnerability to downturns. 3. Neglecting time horizon. Investing aggressively when nearing retirement can jeopardize your savings. 4. Failure to rebalance. Letting your portfolio drift from its target allocation can expose you to unintended risks. 5. Chasing performance. Investing in last year's top-performing assets often leads to disappointing results. Recognizing and avoiding these mistakes ensures your asset allocation works for you, not against you. Dynamic asset allocation is a strategy where you adjust your portfolio in response to changing market conditions, economic trends, and personal circumstances. Unlike a static allocation, this approach allows for more flexibility. Here's how dynamic allocation works. 1. Responding to market trends. During a bull market, you might increase exposure to growth assets like stocks. In a bear market, you may shift towards safer assets like bonds or cash. 2. Adapting to life changes. As you approach retirement, gradually reduce risk by increasing your allocation to bonds and cash. For major life events like buying a home, temporarily increase liquidity to meet immediate needs. 3. Tactical adjustments. Make short-term changes to take advantage of specific opportunities, such as undervalued sectors or geographic regions. While dynamic asset allocation offers more flexibility, it's essential to stay focused on your long-term objectives to avoid unnecessary risk. Asset allocation isn't just about managing risk, it's a tool for achieving your financial goals. Here's how. 1. Retirement planning. For long-term retirement savings, prioritize growth with a stock-heavy portfolio early in life. Shift toward bonds and cash as retirement nears to protect your principal. 2. Building generational wealth. Combine growth-oriented assets like real estate and stocks with stable assets to preserve wealth for future generations. 3. Short-term goals. Use conservative allocations for short-term goals like buying a home or funding a vacation to ensure stability and liquidity. By aligning your asset allocation with your goals, you create a roadmap for financial success that adapts as your life changes. Asset allocation is the foundation of any successful investment strategy. Whether you're a new investor or managing a complex portfolio, the right allocation helps you balance risk, achieve your goals, and build long-term wealth. Let's recap the key points. Understand the role of each asset class and how it contributes to your portfolio. Align your asset allocation with your risk tolerance, time horizon, and financial goals. Diversify across asset classes, industries, and geographies to reduce risk. Rebalance regularly to keep your portfolio aligned with your plan. Stay disciplined and avoid emotional decision-making. As you navigate your asset allocation journey, remember that you don't have to do it alone. Today's video is proudly sponsored by Faneuil Wealth Management, a trusted partner in crafting personalized financial strategies. Whether you're building a portfolio from scratch or optimizing for long-term goals, their team can help you create a plan tailored to your needs. Call 888-336-8586, visit FanuelWealthManagement.com, or email info@fanuel.com to get started. Thank you for joining us on Money, Finance, Wealth. Don't forget to like this video, subscribe to the channel, and share it with others who are on their wealth-building journey. Here's to your success in achieving financial freedom.